cut off. He got there. 5 minutes to spare. Right. I'm sharing the screen. You can see the screen, hopefully. And
can you hear us well or not?
Yeah, I can hear you perfectly okay. You can hear me.
Only Yuri.
One of Yuri's, yeah.
You hear both of us?
Yeah.
Okay, great.
Yeah, you're on in one place, but you're sharing the mic, so I can hear that. Let's just check with Natasha. Okay.
Можно попробовать, может, я могу наклацать. Куда вывести аудио.
Natasha's listening in the back room, so with any luck. Any news from Anastasia?
Don't have idea.
Yeah.
Is she joining tonight, or is she going to
Don't
listen
know.
to the recording?
I'll write to her. I'll write to her.
Good. The recording's on. So, let's make a start. Any questions from what we did last night?
No questions.
No questions. Good. Right, let's go for the consolidation. We did this as the intro, so we can do a fairly quick overview of it all, remind you of what's going on, and then move straight into question and build up how you can complete the question. Right, that says group profit and loss, which is not what I was after. I wanted the balance sheet. That's in the wrong place. Right, better consolidated statement of financial position. Okay, good. You may well remember that I was basically saying that consolidation is just 1 + 1 with appropriate adjustments, taking into account goodwill calculations and the non-controlling interests. Fine, so things that will happen, the way you can structure your answer, step 1, step 2, step 3, step 4, working all the way through what you've got, looking at goodwill, looking at the subsidiaries' net assets, dealing with the non-controlling interests, then looking at the consolidated retained earnings. Goodwill can be valued 2 different ways. It could be at fair value. It could be the proportional methodology. Okay, the examiner will tell you which one to do, and if it's going to be fair value based. Then for the non-controlling interest, the examiner will tell you how to calculate the fair value of the non-controlling interest. And subsidiary net assets, the primary adjustment could well be a fair value adjustment, although you will recall there can be other adjustments coming in. Most common one to that will be the unrealized profit on inventory that will have to be eliminated, and if the examiner feels in a nasty mood, you'll get the question. There will be a question coming up perhaps with the transfer of non-current assets, in which case you're going to not only have to eliminate the profit on disposal, but you're also going to have to make consolidation adjustments in relation to depreciation. Everything is around the group position. So the group structure here, you can add, this is your, if you like, step one, okay, working one here. You can add a little extra to that because you might have an associate to deal with, okay, and whilst you've got P's percentages, date of acquisition, and of course the balance of P's percentage will be the non-controlling interest, in terms of their percentage there, you'd want that. You'd also want the reserves at the date of acquisition, and you'd also want the cost. What did it cost? Just list those points down in your notes in relation to step one. That will save you hunting through the exam paper, hunting through the screen, trying to find the figures as and when you want. Then we'll have step two, which would be the net assets of the subsidiary. In that context, share capital will always stay the same, so there will not be any post-acquisition adjustment. Okay, and if we have connected with share capital, share premium, another reserve, acquisition reporting date, of course, the share premium will also stay the same. So we could add into that share capital plus share premium SP. Okay, retained earnings. Difference will be the post-acquisition retained earnings, which is going to go and be shared between the parent company and the non-controlling interests. Okay. Other components of equity. All right. What's likely to be the main other component of equity? Okay, the other component of equity may well be a revaluation reserve. Of course, there is a revaluation reserve and the items at the date of acquisition are always being purchased at fair value. If the revaluation reserve is the current indicator of fair value, then there will be no fair value adjustments. Okay, so read the question carefully. You could get both. But fair value adjustments will usually arise where the assets of the subsidiary, the land and buildings, plant and equipment will be at cost. Okay, so if we do have a fair value adjustment, then what is going to happen there? Well, that fair value adjustment, unless it relates to land, will be depreciated. So there will be a post-acquisition depreciation of fair value at the reporting date. Again, as always, depending on the useful life of the asset, that will be a regular charge to the P&L per annum, but as part of the net assets of the subsidiary, it will increase until the total fair value has been depleted and gone. Then we have a PUP adjustment, and if the S is the seller, and the main PUP adjustment you'll always get is going to be on inventory. So if S is the seller, then you'll end up with a unrealized profit adjustment in S. If S is the seller, then clearly the profit of the inventory is in the books of S. If P is the seller, no PUP adjustment in the net assets of the subsidiary in the books of S. The PUP will appear as part of the consolidated retained earnings adjustments. Hopefully that is all coming back from the dim and distant past. Goodwill. Now, for something like PUP and goodwill, easily get this calculation appearing in Section A or Section B. 2 marks. Okay, so be prepared for consolidation to appear absolutely everywhere. Fair value of the consideration. If we deal with it. Hello?
Yeah, we hear you.
Yeah, sorry, somebody just beeped. I don't know if a message came in or if it did, it did. So, okay. Something appeared in my earphones. I'm using a new set today, so maybe it's just the gremlins. Fine. So, fair value of consideration. And it may be cash. Fair value of cash is cash. Good. It may be deferred consideration, in which case someone's going to have to give you the appropriate discount rate to use. If consideration is longer than a year, then there will need to be a discounted element to it. And the other consideration you might get, of course, you might have a share-based case. The examiner will give you the fair value of the shares. You might have cash and shares issued. Then lastly, more likely, will be contingent consideration. Contingent on a particular event, very typically contingent on certain profits being earned within 3 years, 5 years, whatever the buying agreement about. And of course, and you'll need to decide from the information that the contingent is still likely to occur, and you'll also then have to deal with discounting. Okay. Then we have a non-controlling interest coming in. Well, that is seen below. The notes will tell you below that if you are dealing with a fair value, then the examiner will give you the information of calculating the fair value, and that will probably be based around the fair value of the shares of the subsidiary at the date of acquisition. If it's on the proportion share, then that will be the proportion of the subsidiary's net assets at the acquisition date. So if we come down here and remind you, here at the acquisition date, then the net assets, after all the adjustments, okay, you take the proportion of that, 20% there. Okay, if the fair value method is being used, then it's likely to be more, because it's going to be based on the fact of the shares, and the shares will be incorporating elements of goodwill. That's okay. Just pick up how you're going to deal with it, and just make sure you know how to deal with it. Hopefully you know how to deal with it by now. Okay, so that's working out goodwill. So then, sorry, it doesn't work out because I didn't go through the rest of it very quickly. You then come up with a subsidiary's net assets from the workings. That will give you the goodwill at acquisition. If the subsidiary had been purchased a number of years ago, then the chances are you're going to get impairment. The examiner will tell you that the current value of goodwill is X, so the difference is going to be the impairment. Or the examiner might tell you that it's been impaired by 50. It might give you a value of what the impairment is. Right, so that will then give you the goodwill at the report date. Non-controlling interest. Calculation of the overall non-controlling interest. Okay. What is it at non-controlling interest at the acquisition? So if we come back up here, then this is automatically going to be exactly the same. Bring it down here. Okay, so just put that in both cases, non-controlling interest as acquisition. And the non-controlling interest in terms of the post-acquisition reserves. And any goodwill impairment. Now, be careful. The goodwill impairment is only going to be on the basis of the fair value method. Okay, so if the non-controlling interest is at the fair value method, not the share of the net assets, then the fair value method is based on the share price, and the share price is going to be above the total net value. So the share price incorporates an element of goodwill. That's how you're going to work out what the goodwill balance is because of all of that. Okay, so if the proportional method is being used and the goodwill is impaired, then that is going to be 0 in the non-controlling interest, because 100% impairment is going to be charged to.
Oh, you're disappearing. Don't hear you properly.
Okay, can you hear me now?
Right now, yes.
Okay, if it buzzes and crackles and goes in or out, then
No, it doesn't buzzes or crackles. It just the volume just going down, and after some seconds, it is going up again.
okay, that is unfortunately probably the system or the internet.
I see.
Okay, we had some fun and games quite a few months ago, where you might find that it's going to.
Hello.
We don't hear you.
Hear me now?
Oh, yes.
Now very quiet.
Okay, but I'm all right now, yeah?
More or less, yeah.
More
A
or
little
less.
bit quiet.
Okay, I think that's the system, because sometimes the internet garbles and it goes to record it down and tries to catch it up. Is it still an issue?
Yes.
Okay, just a sec. Okay. Can you hear me now? Hello, gentlemen. Can you hear me? Hi, guys. Can you hear me? Speak to me. Anybody there? Hi. Can you hear me? Can you speak? Because I'll see if anything is going on. Hi, Yuris, can you hear me? Hi, gentlemen, can you hear me now? Hello?
Great.
Yeah, you may have heard what I was saying about you. The boys are back.
That's good. Yeah, hear you.
Good old boys' own song. Let me check. Good. Backroom has changed. Yeah, the backroom ladies were hearing me all the time. So all right, but you can hear me clear enough now, yeah?
Yes.
Good. Right, let's go back to where we were, which is a good question. Where was I? Can you hear me? Of course, you can't reply, but you can hear me now, so we'll take that off. That's dealt with that. Fine. I think we're back to what we're talking. We're just talking about the goodwill impairment. So if you're using a fair value method, then the non-controlling interest must take their share of any goodwill impairment. If you're not, they won't. 100% of goodwill impairment will go to the parent company. Okay, so consolidated retained earnings, working 5, 100%. 100% of the reserves and the retained earnings, and 100% of P's other components will also be bought in. Then post-acquisition reserves, the post-acquisition reserves of the subsidiary. Remember, we'll get that from the working here, because it's going to be the increase in the post-acquisition. So everything is going to go on here. Then acquisition reporting date will then give you the balance, which is the post-acquisition. And therefore, the total will be used to go to the share of subsidiaries post-acquisition to P and to the non-controlling interests. Go back to the working. It must have been about here. Yep. And if, for example, there's a revaluation reserve, then any change in the revaluation reserve will also be shared between P and the non-controlling interests. Okay, goodwill impairment, of course, that depends. There will be a goodwill impairment, but depending on whether you're dealing with a fair value element or are dealing with a proportional element, value will be different. Gain on a purchase bargain. What does that mean? Sorry, say that. Negative goodwill. Yep. Okay, so if you're going to get negative goodwill, and none of that is going to go to the non-controlling interest, everything will go to the parent company. You immediately recognize the gain. Okay, you're not going to hold that over a period of time. Good. Not going to worry about the example because I want you to go through. Right, fair values. I don't think there's anything to say about fair values that we don't already know. Cash is cash, deferred cash is at the present value. Shares will be at the fair value at the date of acquisition. Okay. Moving on. Fair value of subsidiary net assets. I don't think there's anything typical to deal with there. You know how you're going to have to deal with a fair value. Typically, it will be on property, plant, and equipment. Okay, you might get a write-down of inventory. You might get a write-down on bad and doubtful debts. But to be perfectly honest, it's going to be the equivalent standard procedures of dealing with that. Right, under IFRS 3, it is possible that there could be an intangible asset that has not been purchased by the subsidiary, but when the parent buys the subsidiary, then the value will include that intangible asset. Okay, so typically one that is there is the internally generated brand. As it's internally generated, it's not going to be recognized on the face of the balance sheet or the balance sheet. But if the parent company pays more than it would have if the brand was not there, then you can identify purchase value, the fair value of the brand. The other type of exercise may well be, for example, customer lists. So there could be a valuation put on the customers. Those will have to be recognized as part of the overall subsidiary net assets. And the same goes with contingent liabilities. If we have a contingent liability, then a contingent liability is normally shown by way of note in the subsidiary because it's not going to be a provision. Okay, but they will have to be recognized on the consolidation. Okay, so they will need to be deducted from the overall net assets and shown as a liability on the consolidated statement of financial position. So don't forget those. That could be worth a couple of marks. Good. Group trading. Well, we've seen about the PERPA rising, but basically any balances in terms of intergroup trading have to be consolidated out. Okay, so loans and cash received between the groups will have to be eliminated. Then receivables and payables, if a sale is made, there'll be a receivable in one, say the parent, and an equivalent payable in the subsidiary, unless there is cash in transit, or there may be goods in transit. Okay, so if they do not balance, have a look to see if any cash or goods are in transit, and then complete the transaction as if the cash had been received or the goods had been received. Okay. Then the PUP adjustments, we've already played around with those. If there's going to be an unrealized profit, you're going to credit inventory. okay, and make the debit in the books of the seller. Credit the consolidated inventory. Non-current assets eliminate out any profit on disposal where an asset, non-current asset, is sold, transferred between group companies. Eliminate out the profit in the books of the seller, but in the books of the buyer, okay, you'll need to work out what the group depreciation charge would be. In other words, that will be the same depreciation charge as the seller, and make the adjustments as consolidation adjustments. So at the end of the day, remember the circle, parent, subsidiary, all transactions that happen in between are eliminated. The only time you're going to recognize transactions when they come in, that will be the group, and when they go out. Okay, so the value coming in, the value going out will be the consolidation. Everything else has to be adjusted. Right, so the adjustments, we talked about that. Examples. If you want to go through the examples, then you can download the recording and freeze it. But you got questions to get through. I think it'd be better than doing the examples. Mid-year acquisitions. All right, mid-year acquisitions. At the end of the year, the subsidiaries' net assets will be consolidated. End of story. Okay, but if the acquisition took place at mid-year, then you're going to have to work out what will be the retained earnings of the subsidiary. So look at the information that's given to you. Sometimes you have to work backwards to get it, but look at the information that's been given and work forward from the opening balance, or work back from the closing balance to the point of acquisition. So opening balance, you add the profit for the subsidiary, prorated. If you've got the closing balance, and then you'll subtract the pro rata portion of the profits under the control. Okay. Any questions? Good. I'm now going to have a look at associates. For the simple reason, the question I'm going to give you is a consolidated statement of financial position with an associate to start with. So, associates, this was for your home. We didn't cover the associates. I think I just very quickly worked through it. In terms with the associate. The associate, of course, is not under your control. You'll probably get a question where you will have to decide. Is it an associate or does it have control? Okay, so be aware of the different variations. Control is having 50% plus one share, plus voting rights, but it could be by contract. You could have 60% of the voting rights, but you have a contract that you're not going to utilize 20% rights, therefore you don't have control. You could have a 40% holding. You have a contract that 20% of the other shareholders basically do everything you want them to. So in that instance, you have control. Just look at what you've got. With the associate, the same again. With the associate, you don't have control, you have significant influence. Deemed significant influence is that you hold more than 20% of the shares. Okay. And you'll have a member on the board. If you have control, then you would expect to have the majority of the board, or 100% of the board will be doing what you say. But with the associate, you don't have control, but you have this influence. So 20% or more of the shares, and one person, one or two people on the board. Again, it could be that you have 10% of the shares, which would normally just be an investment. You've not got significant influence, but you have an agreement, written agreement, legal agreement with another shareholder. You have 10, they have 20, you got 30. They allow you to exercise the significant influence. Right, if with a statement of financial position, okay, as I say, it's looking at you are dealing with equity accounting, not consolidation accounting. Okay, the unrealized profit calculations will still be the same, but you're not going to be worried about whether it's the books of the buyer or the seller. You just work it out, whoever sold, whichever direction, doesn't matter, but you apply the PERP, okay, in terms of the associate coming in. Intercompany, are you going to eliminate statements of financial position? Are you going to eliminate intercompany balances? Yes or no? Why?
Because it is not included as line by line consolidation.
Yeah, it's not a consolidation. Consolidation is line by line. This is just working out. This is just working out basically the overall cost, share of net assets, what you got, plus the change in your share of the retained earnings, for example. Okay, so it's just one line. Do you have goodwill? No, you don't. Goodwill is consolidation. Okay, on equity accounting, just have the total cost of your investment. Okay, if you're doing consolidation, remember you have the cost of investment less the fair value of the net assets acquired, difference being goodwill. Here you don't. So goodwill is not shown separately, it's incorporated in the overall consolidated investment, sorry, the overall equity investment. So do you have impairment of goodwill? No. What's impaired? There won't be an impairment of goodwill because you do not have goodwill with the associate, but you will have impairment of the investment in it. Okay, so again, that's just adjusted on the one line. All right, good. It looks like you guys are okay with associates. So let's set you off for a question. Unless you have any questions.
No.
Good. Right, question 376, Paladin. What is required? Consolidated statement of financial position. Okay, what we have, we've got investments. We've got Saracen, and we've got Augusta. Now, straight away, just looking at the names, you can tell me which is the subsidiary and which is the associate. Saracen begins with S, so that's a subsidiary. Augusta begins with A, so that is going to be the associate. Okay, the examiner doesn't always do that, but most of the time, it's quite useful to know that. Okay. And when you look at the notes, it will make it clear anyway. Which is which. All right, what's the first thing you're going to do? Okay, on the question, bear in mind this is typical of what you're going to be seeing because it's computerized. Take the marker and just highlight Saracen. Okay, you can do a couple of, hopefully you don't get the moving circle on your exam. Okay, you can do a couple of markers. Okay, I'm not responding. Now it is responding. Now it's going crazy. Okay, good. Just do a couple of markers to remind you which column is the subsidiary. Okay, what are you then going to do next?
The net assets.
Well, not yet. You'll read it through.
The percentage.
Okay, read the question through. Okay, just to see what you've got. But there will be a couple of things that you'll need to set up. Okay, hopefully you've been practicing this. But one of the first things you'll need to set up will be the consolidated statement of financial position. Okay, so you'd want to set up the, might deal with the equity side of it. How does it go on the question? It shows you the assets and then equity and liabilities, okay? So you'll set up assets, then you'll do equity, liabilities. Having practiced this, you will know, I sincerely hope, that how many lines you're going to have to leave to put in, but you'll also know that you can start transferring things across. Okay, so set up your pro forma. Go back to the study tech. No, we don't. Okay, so what do we have to do? We have to add property, plant and equipment, but what could there well be on property, plant and equipment?
Valuation.
There might be a revaluation, there may be intercompany transfers. Intangible assets, the intangible assets are in the parent company, so there probably will not be any issues. So maybe, having read through, and if there are no issues, transfer that immediately into the answer. Even if we do have adjustments to make on property, plant and equipment, we've got 40 and 31. Okay, on the pro forma, you'll have property, plant and equipment, open brackets, or you might use a cell. So you just want to, you have your total over here, but in the cells or in one cell, just put in, if you remember, just put in 40 and 31. So put the 40,000 in straight away and the 31 in straight away. Or you might have it in the big cell of 40,000 plus 31,000. Okay, and of course, you might put that straight in as the final result. Okay, but the important point is, either way, you show the marker your full workings. Now, you've told me you've both gone through the video on this, so it's whichever way you are happier with, whichever way is going to get the marks for you to deal with that. All right, what else do we know that we're going to have to deal with here? Well, okay, we're going to have going concern to deal with, and we will have non-controlling interests to deal with. So set up the pro forma, transfer in the details you know will be going to be transferred in to work out any particular issues. Deferred tax, for example, you might have a deferred tax calculation to work, but possibly unlikely. So with deferred tax, you can just put 15 plus 8 straight in your draft answer. Okay, then in terms of your workings, and head it on the spreadsheet or the next page if you're using word processing Word, head it up workings, and then just put in control, your circle, parent, subsidiary. You probably won't have you won't have the graphics to be able to do a circle. Doesn't matter, but just put in the detail, percentage holding, then your non-controlling interests, the cost, reserves, year-end date, acquisition date. Just put that detail in. Then you can move in to work out step 1, step 2, step 3, etc. Okay. Right, so for this, what I would like you to do is basically start working through the step 1, step 2, step 3 elements of it. So read the whole thing through, work out what adjustments you think are going to have to be necessary, and then tell me what will be the net assets of the subsidiary. What's the subsidiary's net assets? Step 2. Okay, I'll give you 5-10 minutes just to read that through and see what figures you come up with.
Can you bring up
Numbers.
numbers? Yeah.
You haven't got the numbers. Ah, okay.
Yeah, but
But I do not have.
other you yeah.
All right, this is going to be fun because
I have rewritten also all balance sheet of both companies. I need just information.
just need the information. Okay, there's the first information.
Okay, it's enough.
There is also notes.
Yeah, maybe if you got a smartphone camera.
Okay, I will just
We'll share.
I will just make a photo from you.
Okay, yeah, then you can move it around, copy what you believe. Okay. Yep, I heard click. All right. So you got that. You've got all the balances. There's the other information. Okay.
Okay.
Good. Give you 5-10 minutes to work out how you're going to split the subsidiaries' net assets, acquisition reporting date, post acquisition, and read through the notes 1, 2, 3, 4, 5. Decide how you're going to deal with those. I'll be here, so when you've got something, give me a shout. I'll hear you. Okay. Just work through where pick up. Looking at the net assets, and we take a break for coffee. Right, what information do we have extra here that we're going to be dealing with? Note 1, non-controlling interest is at fair value. Share price of $3.50 per share, so we can work that out. Fair values of property, plant, and equipment were equal to its carrying amount, with the exception plant, which had a fair value of $4 million above its carrying amount. Okay, so that's going to tell you that there's going to be a fair value adjustment in the net asset working. Okay, when did we acquire Saracen? Got a payment of equity in October 20, a majority equity in Saracen. Okay, what's the year end that we're dealing with here? September X1. Okay, so we acquired majority holding at the beginning of the year. All right, good. So it had a remaining life of 4 years. All right, so it's going to be 1 year's charge of depreciation to the P&L, and therefore the cumulative depreciation for the fair value adjustment is also going to be based on 1 year. Right, so we have to bring that in. And we've got Saracen's customer relationships as an intangible asset, the fair value of $3 million. Saracen has not yet accounted for this asset. Trading relationships with the customers last on average. So we're going to have a fair value intangible asset adjustment into the assets as consolidated adjustment. And it's telling you here that there is an amortization over 6 years. So if it was 3 million, then there will be a 1/6 amortization, 500, to go into the adjustments. Note 3 looks like it's a PUP. We've got goods brought, marked up goods 30%. Okay, so that's going to be an unrealized profit. Which way does it go? Paladin made the sale, therefore the adjustment will be in the books of Paladin. You don't have to worry about the adjustment in net assets of Saracen. Then we've got impairment tests on consolidated, was not impaired. The value in the investment of Augusta was impaired by 2.5 million. Okay, so we need to look at that. Augusta, of course, is the associate. All profits accrue evenly throughout the year. Okay, so that's a fairly typical question that you will get in Part C. The whole point here is to maximize the marks, get as many marks as you can. Okay, so the more you get down, the more you can demonstrate to the examiner that you've got the correct element. Even if you don't get the element into the final balance sheet, the marker can see that you've calculated it correctly. You'll get marks for the calculation. You may lose half a mark not putting it onto the face of the balance sheet. Okay, but of course, if you do the calculation on the face of the balance sheet, it should automatically come up. Right, so let's do the subsidiaries. Net assets, we have date of acquisition. We have reporting date, consolidation date. And then we have post-ac. All right, of course, you'll be doing this on a spreadsheet basis. So if we have share capital, What's the value for the share capital? 10,000. 10,000. So that should give you an automatic, if you set the equation up right, give you an automatic post-acquisition of 0. Retained earnings. As these are workings, it doesn't matter if you use shorthand. But of course, if you're, when you put the detail onto the face of the balance sheet, you just want to make sure that you do spell it out fully. In the workings, you can use shortcuts. That's okay. That's 12 for at the date of acquisition. What was the date? What were the retained earnings at the reporting date?
18.
Okay, so what's the increase? 16. No, the increase is 6. Now, if you put 16 down there, then you would have lost maybe half a mark. Maybe you would have not lost anything because the marker would see that you've done just a silly miscalculation. But of course, if you're using a spreadsheet, you've got the correct formula in, you'll get 6 anyway. You would not get 16. Now we've got some fair value adjustments. All right, fair value adjustments to plant.
4,000.
4,000 acquisition. 4,000 at consolidation. Now you can do this both ways. You've got a fair value for plant, you've got a fair value for depreciation as well. Okay, and it's based on 4,000
1,000.
over 4 years, and you got 1,000. Now it may seem silly, but put the calculation in, show how you get the 1,000. And of course, don't forget, that needs to be a bracket. All right, so there's a post-acquisition of 1,000. All right, the other way of doing this, and I'll just pop this into the system in red, is you could have 4,000, and then on consolidation it's worth 3. Okay, because you've got a 1,000 consolidation, and so therefore we need to put the adjustments in. Just make sure you get the brackets the right way around. Okay. Right, what's next? We've got a fair value adjustment again.
Intangible assets.
But this time it's the intangible. So same again, we got 3,000. If we do it on a separate basis, then what's going to be the amortization? If you use the word depreciation, the marker's not going to penalize you for that. So it's the 3,000 divided by 6, which gives you 500. That 500 will go to post-acquisition. So now we can add this up. And again, if you set up the spreadsheet, it should automatically do it for you. 29,000, 33,500, and 4,500. Okay, the 29,000 acquisition is going to go to your goodwill calculation. Then the post-acquisition is going to move across together with the reporting date, post-acquisition, movements into the retained earnings together with the, I always want to call it non-controlling interest. Okay. By the time you get to the exam, you want to have pro formas already in mind how you can set up the column calculations here. All right, so set up the appropriate formulae, and then you can just slot the figures in, and it will work it out for you. Right, let's take 15 minutes for coffee, if that's okay.
Okay.
See you back in 15 minutes. Shall we continue? That's a good idea. Right, the recording's rolling. So, goodwill. What do we know if we're going to calculate goodwill?
I'm sorry. Just 1 minute. Wait for Yuri.
Okay.
I'm here.
Okay. Yep.
Yes, up.
It's a roll. Good. Right. Goodwill. Have you worked it?
Yes.
What'd you get?
37,000.
37.
Yes. Oh, sorry. 15,000. Sorry. Million.
Pity. I was going to ask you, how on earth did you get 37?
No, it's okay. I just looked at the
Was
number
the first
investment.
Okay, right. So you can tell me, in terms of, we've got straightforward cash.
Mhm.
You know, it's 32. Yep. Let's move that across because we can put some calculations in. But we've got other components. We've got the deferred consideration. All right, coming in. So what's going to be the deferred consideration?
1.4 million.
1.4?
Oh, sorry, 5.4.
No, it's 5.4 is the... Yeah, all right. 5.4 is the consideration that is deferred.
Yes, and
But
discounted.
bringing it to, and it's at 8%. So bringing it back,
Mhm.
okay, makes it 5.
Yes.
Bring it back 1 year makes it 5. Sometimes you have to work it out. Sometimes the examiner will give you any particular calculation or any particular result of what you have to what you'll have to use to work out what the deferred consideration is. So as we're dealing with a fair value, we need to bring in the non-controlling interest. That will be 2,000 shares. And we are told that the fair value was $3.50 per share. So that will give you 7,000. That's okay. So that will give us the total in terms of the payment side of things. 37, 42.
44.
44, yeah, good. Glad somebody's watching me. Right, so that will give you 44,000. Then we have the fair value of the assets at acquisition, which will come from,
Our previous calculation.
yeah, which is 29,000. So we pick that up. That will give you 29,000. And that will give you good acquisition of 15. Right. I'm guessing here that you'll potentially get half a mark for putting in 32,000. You'll get half a mark for putting in the fair value. Majority of the marks fair value will come through in terms of the calculation that you've done here. And then you'll probably get 1 mark working out deferred consideration and 1 mark for working out non-controlling interest. So if we're working out goodwill, there could be 3 marks available. Okay. So get those 3 marks. It can be reasonably straightforward. Right. Next up was the non-controlling interest. Non-controlling interest may just be 1 mark, 2 marks. Very straightforward. There's a fair value on the acquisition, which was known as 7,000. That was we worked out before. Yep. 1,000 shares at $3.50. So you might just get half a mark for that. Yeah, that was working out here. You just get half a mark for that for putting it into non-controlling interest. Okay, then we get a post-acquisition. Post-acquisition element of the profits. Yep. And we know that that's 4,500 at 20%. Okay, so again, 4,500 would come here. Okay, so that's the overall difference for post-acquisition. So we can put that in 4,500 at. Still there, guys?
Yes, we hear you.
It's all right. I've just hit something and I've done. All right, we'll carry on. Hopefully, nothing.
Yes.
So that will give us 900. I used the right pen. So that's 7,900. Okay. Controlling interests. What about the group retained earnings?
For the year, total sum.
Yeah. Have you got the total? Have you worked it out?
35,000.
Yeah, 200. Consolidated retained earnings. Okay, so we got P. Their share is going to be the share of Paladin's retained earnings. 25,700, yep.
Mm-hmm.
From the information we have to add to that, 9,200. Okay with that? So we get 34,900 will be the parent's retained earnings. Agreed?
Yeah.
Yeah, you sound a little bit not quite sure about that.
Yeah, it's okay.
You've got it. Okay, because sometimes they will give you, as you can see here, you'll get you may get it at the end of the year, or you may get an opening balance plus the retained earnings for the year. Okay. So the examiner, many students would just put in the opening balance. They wouldn't add the 9,200. That's what the issue. What about S?
We have to add 80% of the.
We've got the 4,500, and we have to deal with that at 80%. 4,500 is the post-acquisition change in the profits. Saracen's post-acquisition profits.
3,600.
Yep. So it will give you 3,600. That's okay. What's next?
Unrealized profit.
Oh, just a second. Unrealized profit. All right.
Or we can take the interest part from the future payment.
Or, yeah, but hang on a second. What about
One more time.
Augusta.
Too low.
We don't hear.
I don't hear you.
Okay, Augusta.
Stop. We have an impairment of 2,500.
Yeah, but you've also got the post-acquisition profits for Augusta. Investment in the associate.
1.2 million. Yes, I see.
Yeah, so the post-acquisition profits on Augusta were 1.2 million. Yeah. How much of that belongs to us? Well, that's 1.2 million for the entire year.
Yes, 25%.
Oh, yeah, but how long has Augusta been?
11 months.
8 months.
October. Yes, yes.
Okay, so we take 8/12 of the profit, and we have a 25% share of that. That will give us 200. Okay. And then we also have the impairment lost. And the impairment loss was 2,500. Okay. So the impairment loss, as this is a associate, is going to be charged against consolidated retained earnings of P. It will go straight in. Okay, it's nothing to do with the subsidiary. So separate line, deduct it from the consolidated retained earnings. Then we can deal with the PUP. Okay, what's the PUP?
600.
Yeah, we've got 600,000. How do we get the 600,000? 2,600,000 at 30 over 130. Right. Go back to the question. What does it tell us about PUP?
Parent sold it to the subsidiary.
Yeah, and we got
30%.
2.6 markup. 30% on cost. So if we have sales, cost of sales, profit, yeah, the profit is 30. As its markup, it's 100. And therefore, the sale is 130, less 100 of the cost as the base. So that will give you the ratios of what you want to deal with. Yeah. We know that the inventory included goods bought from Paladin at 2.6 million. So that's the cost. Yeah. So to work out the profit is going to be 30 over 130, which is the sales price, which incorporates that profit of 30. Okay. So that will be 2.6 million at 30 over 130, and that will give us 600,000, which, as we're working to thousands, straightforward 6 course, it's a charge. What's next?
The interest part of the deferred payment.
Yeah, we got the deferred payment unraveled. So having worked it out in terms of what is its present value, as you progress forward, then that is going to be charged at an interest of 5,000 at 8%. And if it was over 3, 4, 5 years, depending when it was, then you'd have to work out, because that will be 5,008%, 5 8 are 40. So that will give you 400. Therefore, the next time you're going to have 5,408% for the next year, and so on. Okay, so it looks like it's a bracket. So that will then give you a total of 35,200. So all that's left now is the one line for the associate.
We have cost.
So what do we pay? We paid 10,000. Okay, we've got the profits, 200, but the investment is impaired,
Impairment.
500. So that will give you a carrying value of 77.
700, yes.
Okay. So just with those workings, without doing the actual balance sheet statement, you will have par. Right, but if we look at the actual balance sheet, what will be the property, plant and equipment?
74,000.
Okay, so in that case, you got the standard 40 plus 31, which you get directly from the information, but you have to add a 4,000, 4 million fair value adjustment to that. Yep. But of course, if you're working on a net basis, it will only be 3,000, 4,000 gross less 1 year's depreciation. So that will be minus. Yep. Okay, what about other intangibles?
Intangible, we will receive 10,000.
Okay, other intangibles, you got the original 7.5, got a fair value recognition, and again, that is going to be depreciated or amortized, whichever way you want to deal with it. Current assets?
35,100.
Yeah, because the difference there is going to be the 600 pup.
Yes, yes. We exclude the unrealized profit.
Deferred tax is going to be a straightforward adding together. Current liabilities.
We add the liability for the interest, for the deferred payment.
Yeah, you got 11.6 plus the 8.7 plus 5.4 deferred consideration, which was the original 5 plus the unraveling of the interest. Yep, so your debit profit and loss finance charge, credit the deferred consideration liability. And it's just on the basis of 1 year. Right, good. Okay, so you can handle associates, hopefully. You can handle the balance sheet. But what about profit and loss? So, I think it was Pyramid. No, Pyramid was statement of financial position. So, work through Pyramid for home study.
Is this the number?
BHM. So 377. In fact, what you want to do, you want to work through. If you look at the study program sent through, you want to work through the number 370. Consolidation will be 370 through to 387. Okay, but only just do enough to. Okay, so once you've done a couple, that should be sufficient. Just skim through the remaining consolidation. If there's any areas that you have not covered. Okay, so if we do 378, 378 is consolidated goodwill and the consolidated statement of profit and loss. Right, if I bring up again, I'll take a photograph of that. Okay. Then that. Okay. Then the remaining element of it. See how you get on with that. First of all, work out what the consolidated goodwill and acquisition is. Give me a shout when you've got that worked.
Куди проходить?
So, what do you think?
We don't calculate it yet.
What do you think?
Yes.
trying. You've had enough time. Goodwill? What are we told? You guys ready?
Oh, sorry, we all out. My laptop was off. The battery was low.
Okay, you plugged it in and going for it. Have you got a figure for goodwill?
Five million 817.
Interesting. Right, okay. How many marks we get for this? You got 7 marks. All right, let's see how close you got, or how many of those 7s you would have got. Okay, Viagam acquired 90% of Greca in a share exchange. Okay, so good thing to play around with that. 2 shares for every 3. 2 for 3. Additionally, it will pay the shareholders 176 per share acquired on the 31st of December. That's deferred for 12 months. Cost of capital is 10% per annum. Deferred consideration has not yet been recorded. Sometimes you get that where you'll have to put it through, work it out and put it through. So we've got fair value at the date of 650 and 250 respectively. We then got statement of profits and losses for the year ended 30th September. Information. Well, the fair values of assets were equal to their carrying amounts except for 2 items. Okay, item of plant had 1.8 above. Remaining useful life was 3 years. Fine, you should get that with no trouble. You know how to deal with that. Depreciation charge is part of the cost of sales. Okay, that obviously has a direct impact in terms of the profit and loss. Greca has a contingent liability estimated to have a fair value of 450. That has not changed. This has not changed as at the 3rd of September. Okay. Non-controlling interest at fair value, the date of acquisition. Share price deemed to be the representative of the shares held by the non-controlling interest. Fine. Intercompany sales. And the investment income includes a dividend received in a 40% owned associate. And we're told that the underlying earnings for the associates, 2 million. And we're told that goodwill has been impaired by 2 million. Okay, quite a lot of information there. But if we go back to the whiteboard, let's see how we can try and work this. Right, in terms of goodwill, we're looking at what did it cost us and what did we get. All right, what was the cost? We didn't pay cash, we paid shares.
The total investment is 53,400.
Okay, let's see what we got. What did you get for the shares?
2 shares per 3. We bought 9,000 shares, and for this we issued 6,000 own shares.
Yeah. Okay, but what was the value of the shares?
6.5 of those which were bought or those which were issued.
Issued. Okay.
6.5.
We got 90% of the shares. Yep.
We bought. We received 90% of the shares.
Yeah. And what was the share swap?
2.5.
0.5. Can you explain 2.5?
This is the price of the shares which were bought.
That was okay. Just a sec. Where are we going? 2 shares for every 3.
Yes, 2 shares for every 3. So
Okay.
we bought. We issued 6,000 shares.
Okay, so that will be 2/3 of the
9,000.
1,000. That's what I'm looking for. Okay. And what did we do that? Stock market value of 650. All right, so we got in this instance, 2 for 3 at $6.50. Okay. So we got 39,000. 39 million. The shares. What's the deferred consideration?
1.76 for 9,000.
Okay, so we got 9,000. Yep. And at 1.76, but it's a 10%. Yep. So it's 1.1. Be the factor. So that should give you 14,400,000. Agreed?
Yes. Yes.
Then what do we have to add to that? We've got to add the non-controlling interest. We have 10,000 shares. Non-controlling interest got 10%. And what's the fair value?
2.5.
2.5. Okay, so that will give you 2,500,000. Should give you 55,900. Yep, good. Add. Excellent. So that's what we paid, working it out. Full marks for that. Okay, so what's happened in terms of the subsidiaries' net assets? What do we get? Well, we got the shares. Okay, equity shares. We've got 10,000 value of equity shares. Yep. Still there?
Yes.
You agree to 10,000, right? Yep. Okay, what about the retained earnings?
35,000.
Yeah, but those were that was the brought forward at the 1st of October X1.
Yes.
So we got 35,000 for that.
And
What adjustment?
2 months
For
of
that.
out of 6,200.
Yeah. So we got to bring in up to the date of acquisition. So that's the shares bought forward to acquisition.
3 months.
So what was it at to acquisition? 6,200. Yeah.
3 months.
3 months.
Nice.
October, November, December. So that will give you additional 1,550,000. Okay. All right. Then we've got the fair value adjustments. What fair value adjustments do we have?
We have 1,800 for the plant.
Yeah.
Yes, for the plant. And we have a contingent liability for 450.
Okay, so that will be a negative. So that will give you 7,900. Make it 8,000. You have that? That will then be the goodwill. Do that and you'll get 7 marks. Okay, the only element of that I would say will have half a mark to it would be the equity, 10,000. Okay, the rest you'll get at least 1 mark, and the longer calculations you'll get 1.5 marks. Make it up to give you the maximum of 7. Right, so can you work through and see what you can do for the profit and loss statement? Give you a few minutes, 5-10 minutes to start thinking on that.
Годин получився.
У мене получився 6200. Такий самий.
Okay, guys, what have we got? There's a couple, I'd say, tricky issues that you need to pick up on. We're dealing with a profit and loss. So we've got to look at pro rata.
Month out of 12.
9 months. So at some point, you need to make sure that you've got a reminder. You can write this on screen that Greca is 9/12 of everything. Okay, so maybe if we can highlight Greca because that's the subsidiary, and we've got 9/12 of that all the way down that we're dealing with. Yep. What's the other issue?
Internal sales.
Right. Okay. Intergroup sales.
And also unrealized profit.
All right. If we're dealing with the intergroup sales, what exactly is the issue with that?
We have to exclude.
Somewhere.
We have to exclude intergroup sales from revenue, from cost of sales.
Yeah. And when did that start?
Starting from the date of acquisition, 9 months.
Yeah. So we've got sales from Viagram to Greca throughout the year ended 30th. Consistently been 800,000 per month. Okay. But you need to read carefully. At a markup on cost of 25% on these sales, Greca had 1.5 million of these goods in inventory as at a particular time. So throughout the year to the 30th of September, X2. So when did Viagram acquire Greca?
On the 1st of January.
So how many months have we got?
9.
9 months. Okay, so that will be by 9. That will give you a total of
7,200.
7,200. Okay, it's all right because the examiner might have told you what the total sales for the year to the 30th of September was, but at least you can, either way, she'll have to tell you, or he will have to tell you, that it's on a straight line basis, etc. Here, they told you the actual per month, but of course, the other 3 to 24, the other 2,400,000 would relate to non-group sales. That's not the issue. So we've got intercompany sales to eliminate, 7,200,000. Then on that, also got to deal with the unrealized profit. Okay. Then we've got the other issue here. We've got the associate. Okay, we've got a 40% owned in associate, which is held for several years. The underlying earnings for the associate were 2 million. How would he deal with that?
Include it as an investment income.
Income from associate, not investment income. Specifically referred to it as income from associate, which is going to be 2 million at the 40%. Okay, so that will be 800 will need to come in. Okay. Anything else that could be tricky there?
Fair value depreciation and unrealized profit.
All right. All right. Let's see what we've got, and we'll work this one through. Those things you need to pick up on. Right. So what's the revenue? 64,600, which is the parent. We're going to add to that 38,000, 38,000 at 9/12. Yep. Less 7,200, which will be the intergroup sales. We'll give you 85,900. And what will be the cost of sales?
6,475. 64,750.
Okay, 750. Okay. All right. We've got cost of sales. The first one, 51,200, which would be the parent. What have we got to add to that?
26,000.
1,000 at 9/12. Yep.
Yes.
That will be the pro rata. Yep. Okay. Then what?
Exclude 7,200 of sales.
So that will be the intergroup.
Sales.
Yep. So all right, we're just sticking there minus 7,200 for that, which is what we worked out on 800 at 9 months. Yep. So that's contra both of those. We deducted both of those out of it.
We add unrealized profit, 300.
Okay, you can, as long as you got it in there somewhere, then you got the PUP coming in of 300, which is 1,500. Yep. At the 25% markup.
Divided by 125.
Give you the 300. Yeah. Don't forget to include the calculation of that.
And also additional sum is fair value depreciation.
You've got a depreciation element as well.
500.
1,800 over 3 years. Yes.
Multiplied by 9 divided by 12. So, hello, зависимо. Don't hear you. Hello.
Тоже не рухається. Може щось. Ось.
Hi, I'm back.
Okay, great.
Can you see the screen?
We see only 180 and nothing.
Just a second. Let me see what.
We were talking about fair value depreciation.
Yeah, let me just get back. Right, can you see the screen now? Am I sharing the screen?
We see Q only.
Just a second. I'm going to have to open up and share the screen because it doesn't appear to be doing that. Second. Strange, we got the connection, but not the screen. All right. We said about depreciation. Yep. So we got the transfer, the additional element 1,800. It's 3 years, but of course, that is on the basis of 3 whole years, and we're only dealing with 9/12 of that. Okay, so that will give you 450. All right, so the cost of sales element, we've got 85. Okay. Got revenue of 85. The cost of sales will come in at 64,250. Therefore, that will give you 21,650. You agree the 64,250?
Let me see. Yes.
Yeah. You've got the element of the cost of sales with the intercompany sales adjustment. Yep. Then you got the PUP, another charge to the profit, which would increase your cost of sales. And then you got the depreciation, which is an additional charge as well. Remember, the question told you that depreciation is charged to cost of sales. Okay?
Yes. Yes.
Okay. And adding to that,
500 from investment income.
oh, just a sec.
Що там хочеш?
We've got the gross profit there. And you can say 500 from the investment income. Where was that?
The balance sheet on the separate P&L.
Where did the investment income come from? Who dealt with that? The investment income 500.
Yes, this is
All right, but where did that come from?
it's not written here.
Brigham's investment income is a dividend received from its investment in a 40% owned associate. Got it? That's the 500. Okay. If it's paying an investment, if it's paying a dividend, where does that dividend come from?
The profit.
It will come from the reserves, not the profit. It will come from the accumulated reserves. Yeah? Dividends will come, the associate paying the dividend or the associate or the subsidiary paying the dividend will charge the reserves. Okay.
Okay.
Yeah. And when you consolidate or bring in under equity accounting in the balance sheet, yep, you bring in your share of the post-acquisition increase of the reserves. All right. So where you have a dividend, you will eliminate out that dividend. So what you do is basically remove the dividend from the holding company, the parent company's statements. So that 500 will go. Yep. And you'll add that back in the equity accounting consolidation. You'll add that back to the reserves of the company that paid it.
It's associated income.
Yeah. So then on the balance sheet, you will take your share of the retained earnings, which has been increased by that 500,000. Yep. So you won't show it as investment income because it's come from your associate. So you eliminate it. Okay? Good. Right. So it's the same way as you're dealing with if you're dealing with investment income from a subsidiary. Same approach. You eliminate it, add it back, and then bring it through in relation to your share of the post-acquisition increase in reserves. So that 500 is not going to be part of the calculation. You just ignore it because you're doing the P&L here. Don't show it. Okay, so we have gross profit. Then we have distribution costs. What do we have for that? 1,600 plus 1,800 at 9/12. Okay, that will give you 2,950. Then we will have the administration expenses. Again, it's going to be the parent, 3.8, plus your share of the 2.4 at 9 months. Yep. On top of that, there will be a goodwill. Goodwill write-off. Old is 2 million. Goodwill impairment. So those, taking everything together, will be 7,600,000. All right. Now we can bring in our income from the associates. Okay, so the income from the associate, we know, we've looked at this already, was 2 million in terms of the net profit of the associate, and that was 40%. Going to take on that. Okay. That will give us 300. Now we have finance costs. What do you believe the finance costs will be?
420 plus 1,080,000, which is 10% out of deferred payment.
So we got 14,400, yeah,
Multiplied by 10 and
10%, yeah, but
9/12 as well.
9/12 as well, good. Okay, put that all together and you end up with 1,500,000. Yep. That will then give you profit before tax, PBT of 10,400,000. Yep. Income tax. Again, tax 2,800,000 plus the subsidiary 1/6 at the good old 9/12 again. Which will give you 4 million tax. Profit for the year, therefore going to be 6,400,000. Okay, but we have to split that up. Okay, so we have the parent and we have the non-controlling interest. Okay, and the way you'll do that is that you'll do the non-controlling interest first, and the parent will be the balancing figure. So what will be the non-controlling interest? Calculate that. Do that.
575.
Yep.
575.
Sorry?
575, no?
Nope. 575. Nope. Okay, we've got the post-acquisition. Their share of the post-acquisition profit, which was 6.2 for the 9/12. Yep, 4,650. Yeah, what did the calculation on?
Should include fair value depreciation there.
Yeah, just a sec. Okay, all right. So we've got there 6.2 at 9/12 coming in. Yep. But we've also got to charge the fair value depreciation against that. Their share of that was 450. Okay. And we charge their share in terms of the impairment. So Greca's post-acquisition profit was 4,650, depreciation of 450, the impairment of 2 million. Okay. That will therefore bring you to the adjusted profit of Greca. The adjusted profit is therefore 2,200,000. Non-controlling interest is at 10%. So that'll give you 220. Okay, so you start with the recorded 6,200,000 at 9/12 because the non-controlling interest, doesn't come into existence until the acquisition. Yep. But that is the 4650 will be from the account of the individual company. You've then got to make the adjustments for the consolidation. Adjustments 450 and 2 million, the impairment. Yep. That will then give you 2,200,000, of which 10% goes to the non-controlling interest. So that 220 comes here, and the balance is therefore going to be 0, 80, 1, getting this right, 61, 80. I suspect in the real question, you probably wouldn't, you may not have the time to get that far. Okay, but if you practice it and build the speed up,
Okay.
you may have the time to do it. That's quite a heavy question, as you're only dealing with 13 marks. You've only got 22, 23 minutes to pull all of that together. Good.
Okay.
Any questions?
No, no.
Right. Okay. From what we discussed yesterday. Go away. Go. I'm just looking at my diary and it's sending me a message. Right. From what we discussed yesterday, I've set up. Well, I've asked for the mock exam to be made available to you sometime evening of the 24th. So you'll have it available for the 25th. Okay, so we've got a webinar 6 o'clock on Sunday, 24th. Yep.
Mm-hmm.
Then you need to get the mock exam completed online by the 30th, which will be then time to look at it and mark it. And after that, we will meet again at 6 o'clock on Sunday evening, the 1st of December.